bank has collapsed and federal regulators have taken control.
Trying to stem any sort of contagion effect.
Impacting tech startups, leaving customers in limbo.
Raising concerns about the broader economy.
If we hadn't been driving our economy with easy money and then trying to really quickly undo that, we wouldn't be having these problems now.
Inflation refers to the general increase in prices of goods and services in an economy over time. It means that the purchasing power of a currency decreases, and it takes more units of currency to buy the same quantity of goods or services. Inflation is usually measured as a percentage increase in the average price level of a basket of goods and services over a specified period. There are a few key points to understand about inflation. 1. Causes of inflation. Inflation can be caused by various factors, including demand-pull inflation, when aggregate demand exceeds the supply of goods and services, leading to increased prices. Cost-push inflation, when the costs of production, such as wages or raw materials, rise, causing businesses to increase prices to maintain profitability. Monetary inflation, when there is an increase in the money supply, either through central bank policies or excessive government spending, leading to higher prices. 2. Effects of inflation. Inflation can have several effects on individuals, businesses, and the economy as a whole. Reduced purchasing power. As prices rise, the same amount of money buys fewer goods and services, reducing people's purchasing power. Uncertainty. Inflation can create uncertainty, making it difficult for businesses and individuals to plan for the future. Redistribution of wealth. Inflation can redistribute wealth from savers and fixed-income earners to borrowers and those with assets that appreciate in value during inflationary periods. Impact on interest rates. Central banks often raise interest rates to combat high inflation, as higher rates can help reduce spending and inflationary pressures. 3. Measures of inflation. Governments and central banks use various measures to track and monitor inflation. Some common measures include Consumer Price Index, CPI, tracks changes in the prices of a basket of goods and services typically consumed by households. Producer Price Index, PPI, measures changes in the prices received by producers for their goods and services. Core inflation excludes volatile elements such as food and energy prices to provide a more stable measure of underlying inflation trends. 4. Controlling inflation. Central banks and governments use monetary policy tools to control inflation. They may adjust interest rates, regulate the money supply, or implement fiscal policies to influence spending and manage inflationary pressures. 5. Desired inflation rate. Most central banks aim for a moderate and stable level of inflation, typically around 2% to 3% annually. This target is considered conducive to economic growth while guarding against deflationary risks. Understanding inflation is essential for individuals, businesses, and policymakers as it influences economic decisions, financial planning, and investment strategies. Inflation can have several potential dangers and negative impacts on individuals, businesses, and the overall economy. Here are some of the dangers associated with inflation. 1. Reduced purchasing power. When inflation occurs, the value of money decreases over time. As prices rise, the same amount of money can buy fewer goods and services. This reduced purchasing power erodes the standard of living for individuals and can make it more challenging to meet financial goals. 2. Uncertainty and planning challenges. High or unpredictable inflation creates uncertainty in the economy. Businesses may struggle to make long-term plans and investments due to uncertain future prices and costs. Individuals may find it challenging to plan for retirement, education, or other long-term financial goals. 3. Fixed income and savers' losses. Inflation can be particularly harmful to individuals who rely on fixed incomes, such as retirees or individuals with fixed-wage jobs. If their income does not keep pace with inflation, their purchasing power decreases. Similarly, savers may find that the interest earned on their savings does not keep up with rising prices, resulting in a loss of real value over time. 4. Distorted price signals. High inflation can distort price signals in the economy, making it difficult for businesses and individuals to make informed economic decisions. When prices are rapidly changing, it becomes challenging to distinguish between temporary price fluctuations and underlying market forces, leading to the misallocation of resources. 5. Redistribution of wealth. Inflation can lead to a redistribution of wealth within the economy. Debtors, who can repay their loans with money that has less purchasing power, may benefit. Meanwhile, creditors and individuals holding assets that do not keep pace with inflation may experience a decrease in real wealth. 6. Negative impact on fixed income investments. Inflation erodes the purchasing power of fixed income investments, such as bonds or fixed interest savings accounts. The fixed interest payments received may not keep up with rising prices, resulting in a decrease in the real value of these investments. 7. Impact on interest rates. Inflationary pressures can lead central banks to raise interest rates to curb spending and manage inflation. Higher interest rates can make borrowing more expensive for businesses and individuals, potentially impacting economic growth, investment, and consumer spending. 8. International competitiveness. If inflation is higher in one country compared to its trading partners, it can make its goods and services relatively more expensive in international markets. This can reduce export competitiveness and negatively impact trade balances. It's worth noting that a moderate level of inflation is generally considered necessary for a healthy economy, as it can encourage spending, investment, and economic growth. However, high and unstable inflation rates can have significant adverse effects. Central banks and governments aim to maintain price stability and manage inflation within a target range to mitigate these dangers.